Hey everyone, this is the Market Trend Advisory weekend video for July 16th, 2022. This is Michael Bengiat. Here's our disclaimer. You can pause the video and read it. So let's get right into the market trend. As you can see here with all the different colored lights, we've got green, yellow, and red. The overall market trend is really undecided and the market's trying to put in a bottom. So overall, the market trend is uptrend uncertain or uptrend under pressure. We're still below many of the key moving averages. Now, in the S&P, we did get a buy signal in the form of a very narrow follow-through day. So we have now a market count of 1 and 30% exposure, and that will go into effect on Monday morning. But we do have a pretty high number of institutional selling days, and we've actually had a sell signal just the day before, because we're getting a cluster. And a cluster just means that you're getting, we had 4 days in a row of institutional selling days, showing institutions are not buying into this bottom or rally, they're actually selling into it. And we've been seeing this with many, many stocks too, individual stocks. So the overall picture is still pretty undecided. Of course, we have tons of headwinds in terms of inflation, interest rates going up, potential recession, and many other things. We still have the war in Russia-Ukraine and a host of other things too. So that's where we are right now. Let's go on and look at the investing strategies. We're still vastly beating the buy and hold. You can see for the QQQ, it's down 26.64%, and we are down 11.58, acceptable numbers. For the SPY, SPY's down almost 19, we're down 12.7. So that's working pretty well. We are going to be pretty soon kind of redoing this again just to present it in a different way, and then giving you all the numbers for the composite strategy going back to 2013. So that's something we're working on, and we'll have that probably done within a few weeks. So you'll see a few changes to this too, but hopefully all in the eyes of making it easier and simpler to understand and use. And also we'll have a revamped calculator for using when you're actually buying and selling stocks per this market count plan. Okay, so here's the NASDAQ. You can see the market's resisting. It's actually making higher lows here. Let's see if I can just draw this in here. Oops, that's not what I wanted to do. Sorry, 1 second. Oh, sorry, I was doing what I do in my charting. You can't do that in this. So anyways, yeah, we have a 3 higher highs. There's our low where we made a little higher from there and higher from there, and now we've actually managed to get above the 21-day moving average, and it looks like we're going to be tackling the 50-day again. But look at the strong downtrend. We also have the 200-day that's rolling over, and so the market's resisting going in lower, and in the last couple of days, we had very stronger than expected CPI and PPI reports, and the market actually is acting quite bullish against that. So it's something we're watching. You guys see just the RS line too versus the S&P. It's starting to slightly outperform. So maybe this is oversold. We're going to come back to this in a little bit, but interesting action going on here. Not what a lot of people are expecting. So for the S&P, we actually got above the 21-day also, just like and we didn't have as much of a divergence. This was a lower low here, but we are coming back up. Actually, interesting, the Dow, which I don't have a chart here, is actually acting the strongest, which is only 30 stocks, but they've been getting some pretty good earnings news out of a couple of names, especially United Health, which had a pretty big move on Friday. So that's where we are with the indexes. We'll see what happens. There's a lot of overhead resistance here. All these people that bought here and anywhere along here, they're all now hoping to get their money back, especially probably around here we'll run into some problem. But I expect without any more real bad news, we'll probably do a run for the 50, and we may even fake everyone out and go run all the way up here, which would make people think the good times are back. But that would probably, at this point, still be a bear market rally. So in terms of the technicals, it's still pretty bleak, and we're not seeing a lot of improvement, even though the market's trying to put in that bottom. You can just see number of 52-week highs versus lows. I think every single day now for 3 weeks here is we've had more low highs. Percentage of stocks above the 200-day cracked 20 only once. It's been improving, but still it's pretty bleak. The NASDAQ, as you can see, is coming up pretty quickly to its 50 days, so that's improving. We're still pretty far below the 200-day. And the number of growth stocks, we are seeing interesting, quite a lot of strength in some of the leading names. And in our stock pick service, of course, that's what we're always looking for. And we're always looking at just the highest relative strength stocks, how they are acting versus the market. And we're starting to see more and more stocks that are breaking out and holding, which is something we haven't seen in a while. It's too early to tell what will happen because we have seen this before, and then the sellers just come in and bash them all down. So, but we're also seeing, again, another drop. Above this column is telling us the number of stocks that have broken out and are holding their breakouts. In other words, they haven't fallen 5% to 7% below their breakout price, their pivot price. In other words, that's considered a failure of the breakout. So, but it is improving. You see, we were down to 2 just a few weeks ago, and we're kind of coming up, but we're decreasing again. And again, up in volume, down on volume. It's still to the downside of the down on volume seems to be mostly outperforming on that end. So the technicals aren't really giving us a pretty good picture yet. Still very weak, but that can change quickly. In terms of sentiment, there's a lot of, like the American Association of, I'm blanking on the II. Anyways, there's a lot of different reports that go into this group here. And this one, of course, we're still seeing that we're getting more bears than bulls. But it has been improving. We're not as bearish as coloring should be changed too. Should be this lighter color here. And we're also seeing a little bit of improvement on the CNN. VIX has still been red for a long time, but it's improving. But one of the things that we're seeing is that this sentiment is it's been pretty dark. I mean, we got down to extreme fear. We had some panic just back in the middle of June. So that's improving a bit, which we need to sort of wash out the sellers as needed. But since we're in a bear market, a lot of people feel that it's not going to be until we maybe have another dip down, which seasonally would be supported by seeing a final low in October. I don't have any seasonal charts here, but that's being supported by that. And really see very, very extreme black sentiment, such like we saw like in April of 2000, where the CNN went to 1. But that's, that'd be probably the final washout of the bears and set a stage for maybe an uptrend that at least lasts for a while. But it's hard to tell, what's going to happen because we still are in a bear market. So, but overall, this is improving. And so overall, you take the technicals, still weak, but not just horrible. Come off some of their lows. This is coming off lows. So, and the market, of course, is oversold, just as you can see over here. Even that's kind of a subjective term, but the market's starting to look at some of the news and discount it to the future, which the market's always doing. It's always looking ahead 6 months, 9 months. So the first thing that's going to be coming up, of course, everyone wants to know what's going to happen. What's going to happen? So one of the most important things, as we all know, is that what is the Fed doing? So first off, their next meeting is going to be on July 26th. And then, of course, they're going to conclude their 2-day meeting with their policy decision and their interest rate hike announcement. So the big question is, how high will they go? And earlier this week, there was an 80% chance of an unprecedented increase of 100 basis points, or a full percentage point, per the CME FedWatch tool. And that's something I've been kind of keeping an eye on. But by Friday, yesterday, investors were back to betting on a 3/4 point hike. And the chance of that 1% move had dropped down to 31% from 80. So that may have contributed to the big rally we saw on Friday or yesterday. So, but of course, the higher they raise rates, the more the recession outlook increases. And so this has been the market's, issue. Is it discounting recession, or is it really doesn't have enough information? Well, I would say probably at this point they really don't have enough information because there's so many variables. The market's trying to do its best to discount and what things going to happen. Of course, right now it seems to be pricing in peak inflation, just because we're seeing some of the commodity and energy prices, oil especially, is starting to come down. And again, it's brushing off these super hot reports that came out. But again, it's really too soon to tell what the economy is going to be doing in 3 months, 6 months, or even 1 year out. Nobody knows at this point what's going to happen a year from now. We could be in a huge recession. We could be no recession. It was just a fake out. Unlikely, but you never know. The consumer seems to be strong. That's what happened on Friday. The retail report came out showing that consumers are still spending and spending. And they're about 70% of GDP. And so they gave the markets a little respite from selling. So one thing I do want to talk about briefly here, again, I don't have a chart, but one of the things is that when you look at going back, I think about 50 years, when the market gets down, we're talking about S&P, when it gets down about 18%, that's generally been the bottom. It's kind of been kind of suspicious in a way. The market seems to go down 18, 19%. Sometimes it touches 20, and then that's it. That's over. Why that happens, it's almost as if they don't want the headlines of bear market, in stocks, which is not good for Wall Street. So for whatever reason, when it gets down to about 18 or so, it tends to rally, and that's the bottom. But the difference, though, is that are we in a recession or are we not in a recession? So when we're not in a recession, so we're talking about we're in a cyclical bull market. We may have a secular bull market, but then we have a secular bear market inside that. Without a recession, that tends to be the bottom of it. But if there is a recession, we show a much longer bottoming process with numerous tests, usually 2 or 3 of the lows during that. So that's really the big key part. And of course, when we see probably the greatest example more recently is the financial crisis in 2007, 2009, where it took much longer. It was a couple-year process to finally hit a bottom, versus other times. I think it was December. I think it was 2018 where we had sort of a plunge. The Fed ended up cutting interest rates at about 20% down, and off we went again. That doesn't seem likely anytime soon. So this is something that the market's kind of trying to digest, because it's a big deal. If the recession happens, it's going to make a big deal for the stock market. And if there's no recession, then we're probably just seeing the worst of it, especially with the NASDAQ down about 30% at its bottom. So again, that's the big questions. Nobody knows, but we'll be kind of looking at all the data and tracking that. So finally, the last thing is that we have earnings season is continuing. And we do have second quarter earning estimates for tech stocks are being cut pretty drastically, including the price targets and stock ratings. So for those, expectations are low and getting lower. And so we could see it's a positive surprise from some of the larger companies, and that could spur a big rally. And if you look at the charts of most of these stocks, they've just been pummeled. Most of them went down at least 50%, some 80, 90%. But again, that's something that with rising interest rates, that's a giant headwind against a lot of tech stocks just taking off. But just in terms of having a relief rally, squeezing some of the bears and having their heads handed to them, that's what the market likes to do. Just in terms of the whole overall market, for second quarter, the S&P 500 earnings are expected still to grow by about 5.7%. It seems really unlikely, because we're getting more and more pre-announcing of decreasing revenues, compressed margins. And actually for the last week, there were more than 500 analyst earnings and price target downgrades for the week ending July 7th. So that will also probably be another headwind against the market. And so we've seen a couple times companies have continued to beat, but they may not beat as much as hoped for. So we might just still see continued selling on these beats. The one that really kind of triggered the market rally on yesterday was Citicorp. They came out with better than expected. That seemed to be overriding the fact that Morgan Stanley and what's the other one? Sorry, I'm blanking on the other one. They both had kind of earnings misses, and they weren't received very well. But Citicorp seemed to ignite the fires again, the bullish fires. Okay, so that's about it for this week. Of course, we'll be back next week with another video. And good luck trading this week. Okay, thank you.